Thank you all for joining us. It's such a pleasure to have on the program Paul Lountzis, President of Lountzis Asset Management. Paul, welcome.
Thank you for having me, Oliver. It's my pleasure.
Always great to speak to you, to learn from you. And the topic for today is learning from Warren Buffett. You are a keen follower of Warren Buffett for decades. You've shared your insights and your learnings from Warren Buffett on many past occasions. But today we have something special here. Today we're going to go through some quotes of Warren Buffett. And Paul, you will kindly put those quotes into the context of your day-to-day investing and how we can, as investors, make use of the lessons on a day-to-day basis. Before we get into some of these specific quotes, we're going to talk about how Warren Buffett has evolved as an investor and human being over the decades. And perhaps a good first question is, how did you see that evolving of Warren Buffett's investment style over the decades? What sort of sticks out to you over time?
Well, I was first introduced to him when I was a teenager, reading about the Washington Post in the early mid-'70s, and I was a 13, 14-year-old. And that's when I started getting interested in him and studying him. And I followed him as closely as you can at that age, and then now for the last 30 years. And what's fascinating is I've always found studying other people, what they do, their backgrounds, their upbringing, all those things contribute to who they are. And what's fascinating about Mr. Buffett, both as an investor and as a human being, is how he has evolved. And if you go back into the 50s, when he took the Ben Graham course and then worked at Graham Newman after he was originally rejected, and he kept being persistent, and Ben finally hired him. And he spent a couple years, I think Walter Schluss was there, and Ed Knapp from Tweedy Brown, later at Tweedy Brown. And what he did was he was really quantitatively driven, as Ben had taught him. His focus was nets. He did a lot of that in his partnership, and he did some other things, arbitrages and so forth. And so in the 50s and 60s, he was very math and quantitatively driven. He did the Dempster Mill manufacturing, where he learned about labor challenges. He bought a piece of Berkshire and then more of it in the mid-60s. He bought National Indemnity, the insurance company, in 1967. And then he was introduced and became friendly with Charlie Munger, who's had a big influence on him. And Charlie, together, they bought See's Candy. And I just recently saw a video where they were debating it was a better business, and Mr. Buffett had said that he wasn't interested in paying a few million more than they had asked, and Charlie said he wasn't willing to pay $25,000 more than what they asked. But in any case, it was the better business model. He then went into Geico, a portion of the Washington Post, better businesses with more intangible assets as opposed to book value and the hard mathematical way he looked at things. And then in the 80s, that continued. And then in the 90s, he really evolved into doing many private company deals, big ones, buying entire companies. He bought the rest of Geico, Mid-American, and others. And so he evolved buying entire businesses, which he really liked. He liked owning the whole enterprise and employing the people. And then finally, in the decade of the 2000s, all those others were continuing, but he also started doing those one-off deals. When unique situations came up, for example, in 08 and 09, the financial crisis, he did special unique deals. So it's just fascinating how he's taken the original concepts from The Intelligent Investor and basically applied them broadly through the decades in a multitude of ways and in a multitude of companies and industries. And I think it's a wonderful way to learn how he's evolved. He's flexible, very competitive, he's open-minded, and that's really what defines him and is part of what's made him such a great investor.
And we're going to jump right into it and talk about a first theme today, and it's really speaking to that core principle that you alluded to. It's the margin of safety, assessing and managing risk. So the famous quote, obviously, rule number 1, never lose money. Rule number 2, never forget rule number 1. Give us a sense of what you feel and think about when you hear that quote.
I think the margin of safety concept is one of the greatest, if not the greatest, concept ever created in investing. It's chapter 20 in The Intelligent Investor, the book that really impacted Warren Buffett, written by Ben Graham. And when I think of Mr. Buffett, even though many people think of the enormous wealth that's been created and what a great investor he is, part of why he's such a great investor is he almost never suffers permanent capital loss. And what's astounding is when you look at the investments that he's made over his lifetime, both public and private, there are so few mistakes that it's unbelievable. And I think when I think of him, that's what I think about. I think about always buying with a margin of safety, his ability to assess and manage and quantify risk from his reinsurance background and his extraordinary mathematical mind. But the other unique thing is not only is he extraordinary mathematically, he has phenomenal people intuitive skills. So very few people have left Berkshire. He's been outstanding in terms of the people that he's partnered with to bring in, to buy, whether it's Greg Abel at Mid-American or Matt Rose at Burlington. I mean, the list is endless. And so it's an extraordinary combination of skills, but the ability to assess and manage risk quantitatively and his knowledge and insights qualitatively with people and the qualitative aspects of business, which Charlie kind of helped him with, really, really define him and make him unique.
Now, in a day-to-day operation of investing and making investments, let's perhaps take here another quote on margin of safety, and it says, investing is built on estimates and uncertainty. A wide margin of safety ensures that the effects of good decisions are not wiped out by errors. How have you taken this quote and applied it into your own process?
Mr. Buffett always talks about what's knowable. He simplifies everything. People who are really great at things tend to simplify. So as we were talking earlier, Oliver, when you watch Roger Federer play tennis, he makes it look easy. Or Phil Mickelson or Tiger Woods in golf. Well, it's really not that easy. And he's the same way in investing. And what I would say is he always talks about what's knowable and what's important. And focus on what's knowable and what's important. And he can crystallize a few key issues. He can look at anything, or in his circle of competence, which he refers to it as, and always identify the key triggers, the key points. And I would also add to that, not only what's knowable and important, but also what is unique about that company or that business that's not easily replicable by others? What's unique about them? What can they do that others can't? Low cost, better product, better people, combination. And then whatever it is that they can do better than others, is it something that you can replicate and expand going through a runway and keep building the business doing that, whether it's Starbucks or Progressive or Geico or whatever. And so in his everyday, the way he looks at investments on an everyday basis, he's always thinking, what's unique and different about this business? What's misperceived by others? What do I see that others don't see? But it's always underlying that thought process is a foundation of safety, that it's selling for a meaningful discount to what he thinks it can do 2 and 3 and 4 and 5 years out. He has a really long-term horizon, which is also a big advantage. Margin of safety, as we apply it at our firm, it reminds me of the comment Mr. Buffett made about building a bridge that will hold 100,000-pound trucks to go over it. However, then you place a limit on that bridge and you only allow trucks that weigh 50,000 or more, giving you a 50,000-pound spread that even if you made some structural errors, you're really protecting yourself and the bridge is safe for the occupants and for those below. And we try to utilize the same approach when we're evaluating companies that we want to buy. When we were buying Bed Bath & Beyond, we were very fortunate. Typically, retailing is an industry that I don't find that attractive. It's capital intensive, it's highly competitive, there's a great deal of square footage in this country on a square footage basis per population. And so retailing I typically don't like. However, we felt that Bed Bath & Beyond had several sustainable competitive advantages: no long-term debt on the balance sheet, excellent breadth and depth of merchandising, great management, and as a result, we ended up buying a great deal of it. We were lucky. We bought it in the low 20s, all the way up to 30. It's now in the mid 70s. They've also been avid buyers back of their stock as well. But the margin of safety there, we basically, when we deducted the cash, we basically felt that they had an earning power at a very low multiple of normalized earnings. And so as a result, we bought a great deal of it for our clients, and we were fortunate. Linens and things ended up going out of business, and there's really no major competitor to them today. And so we ended up buying a great deal of Bed Bath & Beyond, and the same applied with Lowe's, another retailer that we felt was a leading player along with Home Depot and was underperforming. And so those are two examples that we thought we were buying them at low valuations relative to what their normalized earning power would be.
Let's move on to another area which, of course, is related to everything that we are talking about, but it speaks explicitly to patience and the value of inactivity. So here's a famous quote, only buy something that you'd be perfectly happy to hold if the market shut down for 10 years. I mean, this is inconceivable for most institutional money management today. How does one think and act in such a way?
Patience is embedded in his mind, and it's basically a core characteristic that has defined him for a long time. He really likes buying and holding things forever. And as a result, there's some businesses that you can do that in some cases, and many that you cannot. For example, technology, that's very difficult to do. But he's very, very patient. When he identifies businesses that have his characteristics, high returns on capital, unique competitive positions, structural competitive advantages, big entry barriers, good people managing the ship, and he can buy it at an attractive price. Once he finds all those, because he doesn't find them often, he makes a meaningful commitment to it, and then he's very happy to hold it for a long period of time. Coca-Cola, Geico, many, many others. And I think that patience is a real benefit. Now, another blessing he has, in addition to his extraordinary gifts, is he has quasi-permanent capital. So having that $72, $73 billion afloat enables him to also maintain that long-term perspective. But I think it's just ingrained in him to be patient and focus on the long term. And that's a big advantage. It's a big advantage. And at our firm, what we try and do, we obviously don't have insurance long tail float to use. So what we do is we try to be very, very selective on who our clients will be, that it's very clear to them how we invest and what our long-term horizon is. For example, clients that we're going to manage hopefully some of their capital, if it's going to go into the equity markets, we require or ask for typically a minimum of 5 years. They should be able to have that money invested for the long term, a minimum of 5 years. Now, it's not locked up or anything. They have access to it at any time, but we want them to be thinking in a long-term horizon. And I also have 20 and 30-page letters that I give to our clients so they can kind of get a sense of how we look at the world. In addition, the patience and inactivity, it's reflected in our core holdings. We've owned Berkshire and several other companies, Abbott, LabCorp, since our firm was founded over a decade ago. And we've held them and added to those positions over the years. So we are very, very patient. We try to find great businesses run by terrific people, available at attractive prices. And once we do, we hold them for long, long periods of time, very similar to the way Mr. Buffett operates. And one final point is we also are reasonably concentrative. Our typical portfolio will only own 10 to 15 stocks, which again is similar to what Mr. Buffett does. So we're very, very patient. You don't find really great businesses that often that meet all those criteria that I just delineated. When you do, you really have to step up and buy a meaningful chunk of them.
And Paul, you mentioned this long time period of holding an investment. Warren Buffett says our favorite holding period is forever, from the 1988 annual report. What do you think about when you hear that?
The holding forever is far more difficult for most investment firms, even if they have an extraordinary client base, because we don't have quasi-permanent capital like Mr. Buffett does. However, it's an important caveat. We are always evaluating our holdings, and a couple great examples today where we've been very, very fortunate are a couple of retailers, Lowe's and Bed Bath & Beyond. We've been very fortunate owning both of those for the last several years, and we've done very, very well with both of them. And we're constantly evaluating the multiples they're trading at. We're looking at their future prospects. We're looking at how they're allocating capital. For example, Lowe's bought $3.6 billion worth of stock back last year. They pay a nice dividend. They're looking to continue raising their operating margins higher into the high single digits, possibly even to the low double digits. And so we're constantly reappraising our companies to making sure that we are evaluating at that current point in time. So Lowe's, for example, might seem very expensive. We paid in the high teens for it several years ago, and last year they earned $1.70, $1.75. And so it seems expensive at 49. But when you evaluate things they're doing, the robustness of the housing market, and their buying back of stock, it's not as expensive as it at first appears. Again, we're constantly evaluating it. We did sell a little bit, but the same holds true for all our other holdings. So we're constantly looking at holding things for long periods, but the moment we feel that the long-term prospects are not justified by the current valuation, or management changes, or things change, we are not averse to selling. We're very happy having done as well as we have, and when we think something like that has occurred that isn't to the benefit of our clients long term, we will sell it. So we don't hold things forever like Mr. Buffett does.
And of course, that was back in 1988 that Buffett made that statement. Thinking back to the initial discussion about his evolution as an investor, in what context was that statement, do you think, made? I guess the investment in Geico happened in the early 80s, and certainly a Ben Graham net investor would never say this.
That's actually a great point. I can't speak, obviously, for Mr. Buffett, but my sense is he likes permanence and continuity. And he started buying Geico in the mid-70s. He bought a piece of it, and he added several more pieces later in the 70s. And then he bought the rest of Geico in 1995, I believe it was. But he likes long-term permanence, and his feeling is, and I think it was impacted by Mr. Munger, when you find something great that meets all your criteria, you want to buy as much of it and hold it for as long as you can. And Geico is a great example. Geico, many years ago, had a 1% market share. They now have a 10% market share of $160, $170 billion market. And so that really illustrates his views and his philosophy and his approach. Buy something. And I would also say the long-term approach, even though he's executed it with public securities, he really enjoys buying whole companies. And so even though Coca-Cola or Wells Fargo or now IBM or a few of the other holdings he has, he calls them semi-permanent or permanent, it's still not the same as owning the entire company, which is what he prefers.
Now, this notion of patience has a lot to do with activity or inactivity, and there's a famous quote, "Much success can be attributed to inactivity. Most investors cannot resist the temptation to constantly buy and sell." How did you tackle that dilemma in your day-to-day investing, and how do you think about this challenge?
Investing is really about finding unique moments. And it doesn't mean that the entire stock market has to have come down like it did in August of 2011, September of 2011. It hit a bottom October 9th of 2011, or back in 08 or 09, March 9th of 09 was a bottom. It doesn't have to be that way. There are individual companies that you're always assessing. For example, Allergan is a company that we've looked at. It went from 120 to 80. It's now in the high 80s. It's a $6 billion company, $2 billion Botox, 800 some millions Restasis, which may be coming off patent this coming May, which is a big risk. So you just need unique opportunities that meet your criteria to be able to step in and buy them. And so inactivity for us, we will sit in cash until we find what we think fits our risk-reward parameters, because our primary emphasis and focus is avoiding permanent capital loss. We don't look at volatility or stocks going up and down as risk. We view permanent capital loss. That is, we made a fundamental mistake in our analysis and evaluation of the business, and then we lose our client capital. So that drives everything we do. So it's okay with us to be inactive for a period of time.
Now, next area that we're going to talk about is emotions, and the importance of, I guess, being immune to some of the quick emotions that other investors fall prey to. There's a great quote again from the 2004 annual report. We simply attempt to be fearful when others are greedy, and to be greedy when others are fearful.
That's a really, really great quote, and a quote that people really attribute and think about Mr. Buffett on. And the beauty of that quote is it makes sense conceptually what he just said. It's very hard to execute it day to day when you're investing. And the reason is people become fearful for a variety of reasons. And as to be a solid and sound and good and successful investor, you need to overcome those fears. And the way to overcome them is by having done detailed, in-depth analysis on the business and the industry, both quantitative and qualitative, and have done a great deal of work evaluating the management team, again, both quantitatively, how they allocate capital, how they manage the business, how they compensate themselves, etc. And once you've done that, and you have the confidence level in all the research that you've done, you may feel differently, and your fear, you overcome the fear factor, and you can step up and buy it. And I might add, it's not easy. It's very, very difficult of overcoming your emotions. Very, very difficult, because we're all biased and we're all seeing the same things. And you've got to exclude the external noise, and just focus on what you see as the value. It's very difficult, but very important.
And as you were saying that, I was thinking back to the first theme we were discussing on margin of safety and the permanent capital, the importance of that. Now we see that how powerful these components are when they're all working at play at the same time. So I was thinking here, well, you could actually, as an investor, be immune to these emotions and do your research and have the conviction and be prepared to act on it. But if your limited partners leave you, it doesn't do you any good. So we really see how interconnected all of these areas are to, in a way, make it so powerful when they're working together.
That's a really good point, Oliver. And the reality is, when we meet with a client, we really try to spend a great deal of time getting to understand them and their risk tolerance, getting to understand them and their life and so forth, and their risk tolerance on two metrics, emotionally and financially. And they should never take more risk than their comfort level is on either of those variables, their emotions and their financial situation. And you'll find clients can vary. You can have a client who has saved $500,000 or $300,000 or $2 million, and they want it all invested in stocks. You might have another client that's extremely wealthy, worth a great deal more, and they're nervous every time the stock market goes up and down. So the first example, financially, you could argue, maybe they shouldn't have it all in the stock market, but emotionally they're configured for it. And the latter, the opposite applied with the latter. They're financially very well off, but emotionally their makeup isn't really configured to be a stock investor. And so we try to really convey to clients or prospective clients, be patient. We try to really do our homework. Investing is all about moments and opportunities. And again, it doesn't mean the whole stock market has to go down. There are specific areas, and we're generalists, so we'll look anywhere. It's when unique opportunities present themselves, and they just don't happen that often. And it's like Mr. Buffett talks about, investing is like playing baseball with no strikes being called. You can sit at the plate and be very patient. And that's driven partly by the quality and the understanding and the education of your clients. If you have patient clients that understand that your focus is capital preservation, they're not going to be asking you, why aren't you investing on a regular basis? They understand it's a long run game. You want to avoid permanent capital loss. Cash is a residual, which is very painful right now. It's painful because you're earning nothing on the cash. But it's better to suffer short-term pain holding cash than to be buying securities that you don't have conviction and confidence in, that you believe are overvalued and may ultimately lead to permanent capital loss.
Here's another quote and talks to the idea generation that comes about related to emotional swings. It says, look at market fluctuations as your friend rather than your enemy. Profit from folly rather than participate in it.
That's a great example, and a great example for us. And I can give you several securities over my career, but one of them is Berkshire. Berkshire, over its history, has declined 50% or more. I know of three right off the top of my head, maybe 4 or 5 times. So there's an example of a great company, diverse revenue streams, Rock of Gibraltar balance sheet, the greatest investor who's ever lived running it, overseeing it, and it declined over 50%, 3 times that I can recall right away, and maybe 4 or 5 times over its history. Well, those were wonderful opportunities. I remember in August and September of 2011, recently, the A's got down under 100 and the B's got into the mid-60s. Well, the B's today are 115, 116, and the A's are 170,000 plus. So there's a wonderful opportunity if you believe in the business and the people and the valuation to exploit. And I can give you numerous examples of securities that we bought that over the time that we owned them experienced a short-term blip either in their results, but it was a short-term blip. It wasn't a secular change. And we were able to buy more of it at an even more attractive price. The most recent example, real big example, was Wells Fargo and US Bank Corp in August and September of 2011. Wells Fargo went from the mid-30s to low 20s, and US Bank Corp went from the same down to 18, 19, 20. And we were able to buy more of those for our clients. And now Wells is in the low 40s and USB is in the mid-30s. So, those opportunities, if you are convicted in your research, it's all research driven, and both quantitatively and qualitatively. And once you have that conviction, when the market goes down, it gives you the opportunity to buy more.
Now, to relate emotions to the skill, when people say so-and-so is a great investor, one perhaps thinks first and foremost about their ability to analyze companies, read financial statements, make these types of analyses and conclusions. Warren Buffett says emotional makeup is more important than technical skill.
I would agree with that. I have found in my experience, the most difficult thing is to overcome those challenges when the market is really getting hit. For example, the market went from 13, 14,000 down to 6,600 or 6,500. That was a painful time. And it really takes enormous will, iron nerves to be able to step up to the plate and make a meaningful commitment when things like that occur. But you have to you have to have the right clients with a long-term horizon. You have to spend a great deal of time doing research and analysis, both quantitatively and qualitatively. And once you've done all that, those are times. In fact, I have found our most successful investments have occurred when I was buying things, my stomach was churning. And when your stomach's churning when you're buying things, normally that's the best time to buy. But it's also the most difficult.
Now, the next one is on Mr. Market. Is your servant not your master? So going back to Graham, and this was back in 1993 when Warren Buffett talked about the Mr. Market analogy here. Mr. Market's moods should not influence your view of price. However, from time to time, he does offer the chance to buy low and sell high. I guess my question would really relate to, people are often willing to admit how, let's say in 2009, it was a tough environment and it was sort of difficult to look at your stocks and remain neutral and in a way think objectively, rationally. When it's the opposite, when the market's on a high, everything's going well, would you say that's even more difficult to sort of be objective and remove yourself from this party, if you will?
I think one of the challenges is what we try to do is you want to remove yourself from all the noise. And that's a very, very good point, Oliver. When things are really going well is when you have to be even more careful. I have always found it, and I know many of the people in this industry that I have a lot of regard for, I think feel the same way. I have found it much easier to buy than I have to sell. Selling is much more difficult because things change. And when you're buying something at a very low multiple of earnings or enterprise value to EBIT or EBITDA, you really have a good sense that you're buying it at a huge discount. However, just like the example I gave for Bed Bath & Beyond and Lowe's, they've risen meaningfully from our purchase price a few times. And as a result, you have to really dig down and try and assess the future, looking at it because the past doesn't matter. The future is what you're looking at, and they're more expensive. They're trading at higher multiples than when you bought them. Things have changed. So you have to really recalibrate and clear your mind of the past and try and be dispassionate and look at valuing the company today under the existing valuation and under the existing circumstances, industry environment, competitive environment, etc., economic environment. And so selling, when things are really going well like now, is much more difficult. But we're not averse to selling when we are convicted. And even if it continues to rise, if that valuation didn't make sense to us, we'll still sell it. I mean, you're never able really to get it at the final point. But when the numbers don't make sense to us, we're eager sellers.
And it goes back to that margin of safety that
Correct.
We talked about initially. Of course, as prices go up, that margin of safety changes.
Yes.
And then I guess you're faced with the dilemma: do you try? Is it rational to look for other sources of margin of safety? New sources, as your existing source has compressed, and I guess that is really where people are so prone to making mistakes.
My late partner Bill Ruane used to say, "Watch out for momentum," and when things start taking off, you very well could sell too early and miss out on some of that continued appreciation, even though you don't understand it and the valuation to you, given their future prospects, just don't make sense at those kinds of multiples. But that's okay.
Let's move on to the next topic, which is intrinsic value. Of course, any genuine value investor has to understand the concept of intrinsic value. But there are certainly various ways to go about it, quantitative, more qualitative. Of course, the famous quote is, price is what you pay, value is what you get. But give us a sense of those various aspects of thinking about intrinsic value.
Intrinsic value, the discounted cash flow, bringing back what you think that company can generate in free cash over time at an appropriate discount rate. But what we really try and do is we try to look at a business from the foundation up, who founded it. We try to understand it both quantitatively and qualitatively. The quantitative are easy or simpler because the numbers are all there for you to look at. But the real challenge is trying to understand what the numbers really mean and what they're going to be 2 and 3 and 4 and 5 and 6 years out, and what are you willing to pay for those. But we try to look at a business as if it were a building. Try to understand who founded it, what's the culture like, what's the foundation of this business built on. There's the famous quote, every institution is the lengthened shadow of one man, one woman. And I think that really applies. So we want to understand the historical, cultural aspects of what defines and what founded a business and what its foundation is culturally. It's critical. And then we look at a business horizontally, all its competitors, quantitatively and qualitatively. What can the company we're looking at do better than the others? Is it sustainable, etc.? And then we look at it from the top down. We're never going to be macro investors. We never make investment decisions based on macro factors. However, being meaningful owners in LabCorp, we have to understand the clinical lab industry, what's going on in genomics, in esoteric testing, in hematology, in clinical chemistry. It's important. Same with owning Bed Bath & Lowe's. We try to stay on top of what's happening in the housing markets. We read everything we can on housing starts, new home formations, existing home sales, builder sentiment. We try to really dovetail all that stuff. So we try to take the numbers and then create an external mosaic of a multitude of other factors to bring those numbers to life and to give us insight going forward.
And the concept of intrinsic value, of course, can be defined simply as Warren Buffett says. It is the discounted value of the cash that can be taken out of a business during its remaining life. However, he warns that the calculation of intrinsic value is not so simple. As the definition suggests, intrinsic value is an estimate rather than a precise figure. And it is additionally an estimate that must be changed if interest rates move or forecasts of future cash flows are revised. Perhaps really so timely for us investors in this historically low interest rate environment, this reference to these estimates must be changed if interest rates move, and presumably the only way they can move from here is up, which we all know would do to intrinsic value.
But what's fascinating is we're operating today, November of 2013, in an artificial rate environment on a global scale, which is unprecedented. There's liquidity everywhere. And as a result, fixed income investors are being penalized. And the question becomes, long term, what does this excess liquidity mean? And oftentimes, even though this is unprecedented, there are unintended consequences to particular strategies that people use. And those unintended consequences often can be very negative. Now, should interest rates, the 10 years at 260 or so, 250, 260, 270, if interest rates start rising meaningfully, the value of the current value of virtually every asset class is going to decline. And so when you look at the PE ratios today, or enterprise value to EBIT multiples, or any other parameter that you might look at, it has to be assessed and evaluated in the backdrop of these unusually low, artificially low interest rates. So that's a really, really important point. So the market, given where interest rates are, is not ridiculously priced today. It's not cheap. I mean, you can look at the Schiller Cape numbers and others, and that's in the 20s. But if you look at forward earnings, it could be at 15, 16 times, which is historical. However, if rates would start to rise, clearly the market is not as cheap as it may at first appear.
And this particular quote, of course, has so many great insights, and one of which is this estimate versus it's not a precise figure, so versus these price targets that are given out, and again refers to that margin of safety, that it needs to be wide and there is uncertainty and things can happen. I'm curious if you've come across examples in your investing life where that was really played this important role, where perhaps it was easy to see a catalyst out there, or something that would bring the share price up, or it was sort of easy pickings, but there was this steamroller that could come and you could lose so much. How do you deal with that aspect of also assessing business models, whether they're built to really withstand these wide swings in what can happen in the real world?
It all comes down for us to trying to assess and manage risk. And one of the things we try to do is we really try to go back many, many years when we're looking at a business. So something like US Bancorp that we now own, we've looked at it and studied it for over 23 years. And that gives you a reasonable perspective on how management behaves. And we try to focus on three things with many subsets under each. The first is the fundamental economics of the business and the industry in which it competes, because they're interrelated. And so that's the first point. The second point is the quality of management, how well they can manage the business, how well they allocate capital. Good leaders, we look for vision, their ability to communicate and articulate that vision, and their ability to exercise sound judgment. And if you look at a management team over a long period of time, and you meet them as well, you can assess their vision, their ability to articulate and communicate that vision, and their exercising of sound judgment. And so that's what we look for on the management side. And then finally, it's valuation. And valuation is a huge driver, because in many cases, the first two, the economics of the business and the industry in which it competes, or the management, are within our strike zone. So we're very comfortable with both of those factors, but the valuation is at a price that we're not comfortable with. We're simply not comfortable paying that kind of multiple given what we think the growth rates are. I mean, there's a couple great companies, C.H. Robinson's one of them. It's a great company. They're simply not growing in a very challenging environment, and the multiple's higher than we'd be willing to pay. But a terrific company. High returns on capital, asset light, et cetera. And I could give you many examples, but that's just one off the top of my head. So those are the three things we try to look at to really understand. And we don't try to be precise. We say to ourselves, we try to be as simple as possible after we understand the business. What do we think they can grow their revenues? And we try to be very conservative. What do we think, how much operating leverage do they have? What do we think they can grow their earnings? So we think they can grow their revenues 10%, we think they can grow their revenues 15%, and we think that's very reasonable. What kind of a multiple, given the returns they generate, would you place on that kind of a business? And that's what we do, and we're constantly making those judgments. And so that's basically how we decide. But it all comes together, and we will sit and be patient unless we can find some companies that meet all those criteria.
I'm curious in this instance to understand whether you've ever invested in leveraged companies, or is that ever been, have you ever made exceptions to that? Because of course leverage is one thing that can really drive this value and can result in bankruptcy or can result in great things if things go well. So when we think about intrinsic value, leverage really skews that value that could be there for the equity holders. But over the long term, I guess it's a real curse. So have you ever tried to make any allowances for that and compromise and still invest in leveraged companies?
That's a great question. In our history of over a decade of investing at Lountzis, there are two specific companies which were exceptions. If you look at our entire portfolio today, clean balance sheets, very, very secure, but there were two specific examples that come to mind. The first was Cablevision. It was run by the legendary Chuck Dolan, the founder. It was run by Jim Dolan. And it was in the early 2000s. The stock had gone from the 70s down into the high 20s. And we were evaluating it, and we'd met with some people in the business, and they had one huge cable cluster. Connecticut, Long Island, Westchester County, part of New Jersey. It was one huge cluster of about 3 million subscribers, maybe 4.3 million homes passed. And they had not really rolled out in a meaningful way their broadband business. So it was primarily a video business. And we did some work talking to some engineers, competitors and others, and we felt that their broadband business, the cable modem, and their voice over IP telephony business were going to be very significant revenue streams going forward. And it was very easy to do at Cablevision because they only had two head ends, as opposed to Charter, which had all these small clusters and might have had 15 or 1,600. So we liked that. And we felt that their broadband business could achieve 500 to 600 million in revenue. And we thought their voice over IP business could also be substantial. So even though the net debt to EBITDA was very high, 4, 5, 6 times, we felt it was neutralized by a couple factors. They owned a lot of non-cable assets, Bravo, and other broadcast assets, A&E and a couple others. They also owned Madison Square Garden and several other assets. And when we took the value of all those non-cable assets and adjusted them, we felt they helped neutralize some of the debt. And then secondarily, we felt that the revenues and operating income from their broadband business and their voice over IP would also neutralize some of that. As a result, it was the riskiest investment we ever bought. We started buying it in the 20s. It became very challenged. The stock, I think, got under $5 at one point. And we remained confident in the recurring nature of the video business. We remained confident in their cable modem business, which when we bought it might have had 20 or 30 million in revenue. Today it's over $1 billion. Voice over IP also exploded. So all those factors contributed to us buying Cablevision. And fortunately, it worked out. They wanted to take it private in the low 30s, and then it got to 40. And we did sell it and did well for our clients. But that was one example of high leverage. And we tried to neutralize it with those two revenue streams and with the other assets. The other one was Lamar in the billboard business. Same thing, highly levered, net debt to EBITDA just under 5. But we were confident. They have 80% and higher market shares in many of their markets. It's a recurring revenue business. So we felt they could service the debt. And that's another one that we were fortunate and did well in. But they both had predictable recurring revenue streams. The one, Cablevision, had non-cable assets that were very valuable, and they had new revenue streams coming on. And we felt that Lamar, just with their existing recurring revenue streams, would easily be able to service the debt and keep growing. So those are only two that I can think of in our history that were highly levered.
Now, to move on to this notion of the learning machine and knowledge is cumulative. We certainly have benefited from your insights over the years and appreciate that there are always new things to learn. So we're going to draw on a quote from Charlie Munger here, and he says that Warren Buffett is a learning machine. Perhaps not many investors, when they hear about Warren Buffett, not many people out there will think of him as a reading machine, a reading and learning machine. Is that really the secret to his success?
I think trying to explain or define or understand Mr. Buffett's extraordinary achievements and how they were achieved is really impossible. It's a combination of a broad range of unique talents and gifts, from an extraordinary mind, mathematically, a phenomenal memory. He can recall anything. His enormous work ethic, his devotion, his focus, all those contribute to his learning. But what's really fascinating, and what's really one of the really great things about this business, unlike sports where athletes lose their legs, think about if Roger Federer could continue to play and his body remained as he was when he was 25, but his mind had that much more experience. Think how good he'd be at 70. So Charlie, Mr. Munger, keeps saying that Mr. Buffett is a far better investor today than he was 30 or 40 years ago. So one of the really neat things about this business is it's all cumulative. So experiences you had buying Lamar or Bed Bath, they all get etched in your memory and you can keep using those. And as long as you're in good health, your mind continues to grow and you become better and better. And it's not that case in most other areas, and sports is a great example. In sports, the older you get, you hit your mid-30s, you really have peaked. And very few athletes can sustain that. So one of the blessings that has been for Mr. Buffett is his longevity. He turned 83 on August 30th, and hopefully he's got another decade or more to go doing what he loves. But I think that longevity factor and constantly learning and challenging yourself and seeing situations and investments and reading, I think that's really served him well, and it serves us all well. It's a wonderful blessing to be able to just learn every day, see other people's mistakes, learn from other really smart investors, have them challenge your ideas. All that's a learning process, and that's what it's all about.
And when it comes to really making sure that one benefits from these experiences in the past, what do you have in your investment process that ensures you do a good job of that? Most people don't have the memory of a Warren Buffett, so even though they might have had experiences that were very instructive, they cannot draw on them at the right time in the future, or they draw on it too late, or what have you. So what can mere mortals do on a day-to-day basis to make sure that we really can use the lessons learned from past experiences later on?
It's helpful to have checklists. It's helpful to have a database in your head as well as on your computer. It's healthy to write down the 5 reasons you bought something and then be able to refer to it and look back. It's particularly instructive to do that when you've made mistakes. So for example, when we made our Harsco investment mistake, it was a wonderful lesson. And hopefully we won't make too many of those, but your mistakes are where you really learn. And so I think it's healthy to codify those mistakes and to make sure when you're buying something, you've enumerated why you're buying it and you've evaluated against some kind of a checklist to make sure that it makes sense and it's reasonable and it's sound. And I also think it's very, very healthy to have other people that you have enormous respect for to challenge you in a thoughtful, thought-provoking way on your ideas. A lot of firms call it devil's advocate, and we find that to be extremely helpful. Not to attack one another, but to attack the idea. Different people with different skill sets, different backgrounds, different experiences can bring all that to bear and see things that you may not have seen. And as a result, that will make you better. because the goal is to avoid permanent capital loss for the clients. The goal is to assure that you're finding things that are wrong before you make the investment. And the more really quality minds you have, a few great people, 3 people, 4 people, 5 people, whatever, that are all working together to find, the answers or to evaluate the investment opportunity, the better off you are.
And of course, reading with a view to acquire, as Charlie Munger will say, worldly wisdom is what it's all about. And we would be remiss if we didn't talk about some life quotes as well from Warren Buffett here. And one that comes to mind is someone sitting in the shade today because someone planted a tree a long time ago.
I think, if I recall correctly, I think Warren once said that in a foreword to The Intelligent Investor describing Ben Graham. And I think it's really, really important. I've learned so much myself from other people, Mr. Buffett being the best example, but I learned enormously from the late Carl Kniff, from Bill Ruane, from Chuck Royce, from people and firms that I was blessed to work at, as well as from many of my friends. And I began my career in consulting with some very, very talented men and women. And I just learned an enormous amount from them. And so I think it's incumbent, when you've been that fortunate and that blessed and that lucky as I've been, when you learn something, to try and share that and let others benefit from that. I mean, Mr. Buffett's writings, if you just read his interviews and his annual reports and all, it's a fundamentally incredible academic investing lesson. But more than just investing, it's also about life. And a lot of people miss out on many of the things Mr. Buffett has said on how to live your life. Many of those quotes that we've talked about, the inner scorecard. And those have had an even greater influence on me, surprisingly, than even the investing knowledge that I've gained.
Tell us more about the outer inner scorecard.
That came from his father, who Mr. Buffett idolized. His father was an extraordinary man, and he always lived by the view that you should always do what you think is right, no matter what the consequences. And he had an inner scorecard that told him what was right and what was wrong, and he defined it. It was self-defining. He didn't really worry about the noise outside and what others thought. And so if he knew that what he had done was right, it didn't really bother him what the outer scorecard and what others said or thought. He kept to his values and his principles. And it reminds me a lot, Oliver, of I played a high school football game once, and I played terrible. And I had great teammates. And because of that, we won, but not because of me. I was terrible. And that weekend, I was 16 years old. It was 1976, and there was a great quote in Sports Illustrated that I read, and it said, the quote came from Parkinham Beatty's Self-Reliance. And it's a really great quote for quarterbacks or for money managers. And it was something like, by your own soul learn to live, and if men thwart you, take no heed, have no care, sing your song, dream your dream, hope your hope, and pray your prayer. And the point is, you've got to live, you have to think independently, and you've got to live with a value system that you've created that works for you, that you're comfortable with. And it can't be situational. It has to be pure, and it has to come from you, and it's what's inside you. The external stuff doesn't really matter. How people perceive you, if you feel you're a high-quality human being and you've done the right thing, is really what it's all about. And so, in closing, I just find it really ironic that despite all that I've learned about Mr. Buffett from him on investing and other things, really learning about life and the way he's lived, and many of the comments and quotes he's given, from the inner and outer scorecard to generosity, to giving away his money, to living very simply despite his enormous wealth. I think those are wonderful lessons. And the lessons I've learned about how to live are even more profound than how to invest. And it reminds me of a speech that I recall that he gave at the University of Florida in 1998. And he asked the class, that he wanted to do a deal with them. And the deal was that he was going to allow each member in the class to pick one of their classmates and collect 10% of their income for the rest of their life. And he really started thinking about it, and he said, are you going to pick the one with the highest GPA, grade point average? Are you going to pick the highest IQ? Are you going to pick the highest SATs, highest GMATs? And the reality was, what it really came down to, they were going to pick the student or the classmate that was the most honest, that was dependable, that when they did group projects, he shared the credit, that when things went wrong, he accepted the blame, that he or she would do what they said they would do. And he went on all the way down all these qualities. And the irony was, all these qualities are qualities that we can all take on and adopt ourselves. Now, we all try, and none of us are perfect. We don't always succeed, but I found that to be an extremely thoughtful and interesting way of looking at the world. And that has nothing to do with investing. That has to do with trying to be a first-rate human being. And that really, really impacted me. And again, that was 1998 when he gave that lecture. And so I think while his investing career, his legacy, everyone knows about his great investing, maybe the greatest investor that's ever lived. People know about the enormous wealth that he's created. But a couple other things that really stand out are what an extraordinary teacher he's been to allow others to read and learn and grow from his experiences. How many people that he's inspired to get into investing. I know I would fit in that category. And then finally, his generosity by ultimately giving away the preponderance of his wealth back to society. So I think it's a pretty extraordinary life.
And on that note, Paul, I want to thank you so much for taking the time to go through these wonderful quotes from Warren Buffett with us today.
Thank you for having me, Oliver. It was my pleasure.
And I'm sure you will join me, and we should also thank Mr. Buffett and Charlie Munger for providing us with the material to go through today.
No question. I agree with that.